Pratik Gupta, the CEO and co-head of Kotak Institutional Equities, who's joining from the sidelines of the Kotak Chasing Growth Conference. Hi, Pratik. Thanks so much for joining, and apologies for making you wait for a few minutes out there. Pratik, what's the mood like at the conference? We have a bit of a split view out here, whether we're going to be entering into a bit of a correction phase, whether it's bullish or bearish. What's the feedback you're getting, and how are investors feeling about India?
Hi, good afternoon. Thanks for having me on your show. It's a bit difficult to summarize the mood given the scale of our conference. We have something like 820 institutional investors from all around the world and from India, and something like 200 companies. So a bit tough to generalize, but by and large, I would say the mood is neither overly optimistic, nor is it overly pessimistic. It's sort of status quo. There are some concerns emerging globally on the outlook for interest rates from the Fed, the Bank of Japan. Inflation is proving to be more sticky than expected, so there are worries that interest rates will go up a bit more. There are still some investors who find India expensive compared to China, so trying to figure out, is India's underperformance over the last 3-4 months, is it sort of done with, or is there still room to move out of India, or should we come back to India? So just remember, bear in mind that a lot of these foreign investors at our conference, they are coming to India in person for the first time since 2019. So for many of them, it's just of a catch-up trip, get an update. They have large investments in India, trying to figure out what's happening with the companies. But in general, most folks are quite positive on the longer-term outlook. A 2-3 year view on India right now is quite positive, seen as one of the few sort of high-growth economies around the world. So the longer-term outlook is very positive. It's just a question of differences in view on the short-term outlook over the next few months or next few quarters. And as far as the domestic investors are concerned, obviously we had a very large contingent coming in from there as well, across both mutual funds and insurance companies. And there the view is, again, slightly more cautious. A lot of these stocks have run up quite a bit since the pre-COVID times. The multiples are higher. Earnings growth is sort of moderating. We've actually seen some modest earnings growth estimate declines in sectors like consumer discretionary related sectors and so on. So, but they're still seeing net positive inflows every month by and large. So more stock picking, trying to figure out which are the stocks which have underperformed. There still might be some pockets of underperformance, is there, and therefore time to catch it. So in general, I would say the mood is fairly lukewarm, not overly positive, not overly negative.
All right, not overly positive, not overly negative. Pratik, you haven't shied away from calling a spade in the past. You've said that 2023 could be a year of mediocre returns for equities itself. So in a scenario like this, what is it that you tell everyone who's attended the conference? What pockets are you prodding them to shift their capital towards? What are your thoughts? What sectors are finding a lot more favor at a time when everyone's expecting mediocre returns?
So our view still remains the same, that we think the market this year, from current levels, the returns will be somewhat modest. That view hasn't changed. But within that also, as you rightly said, there will be some areas which will do well, some will not do as well. The areas that we continue to like, the sectors that we continue to like are, for example, the banks. The banking sector, even from our conference, we had many, both large and small banks, PSU banks coming through. And by and large, the mood over there is still relatively more positive. The worst of the asset quality issues are behind us. Credit costs are coming down. Loan growth is still going reasonably strong. The outlook for NIMs is modest to maybe a marginal decline. No big concerns over there. The private capex cycle is yet to pick up in a big way, so that could actually result in loan growth accelerating. And frankly, from our perspective, we find valuation still by and large moderate, not overly expensive, unlike some other pockets of the market. So banks is one segment. The other is some of the longer-term oriented investors. We also ask them to look at the capital goods companies, where near-term, the headline multiples may seem a bit pricey, but the longer-term growth prospects are very, very strong. After a very long time, both globally as well as in India, we're beginning to see signs of a private capex upturn. and that could be a fairly long upcycle, and you could see very significant earnings upgrades because of both stronger than expected order book flows or even margins, with again the worst of the commodity prices behind us, commodity price rally being behind us. So therefore, banks and cap goods are the two areas which we are still sort of recommending. The areas where we are sort of slightly more cautious in the short term are mainly the consumer discretionary sectors, where for various reasons we are seeing a bit of a slowdown. Both we saw it in the December quarter, and we're continuing to see it in the March quarter as well. In fact, even at our conference, most consumer discretionary companies are not citing any acceleration in demand as yet, ever since the post-Diwali slowdown kicked in for November, December, January, even February is generally going a bit lightish. There are obviously some exceptions here and there, but by and large, you could continue to see earnings downgrades over there as well.
Got that, Pratik. So positive on banks, positive on capital goods and the capex cycle. We're a little cautious on consumer. Got that. Let me ask you about the Adani factor. I mean, as candid as you can be on television, but is that a chat point in the conference? And what's the sense that you pick up? Has the market and participants, have they put that episode behind? Or is it still sort of causing some amount of unease in terms of what might come with the equity values drawing down, what happens to their debt, and those kind of questions?
So I would say that most of it has died down in the minds of institutional investors, at least. Initially, if you recall, when the controversy first began, the biggest concern was about the systemic risk to the market, to the banking system, to the economy. It's obviously a very large group. So that was the main concern. But given the clarifications from the RBI, the finance ministry, from the various banks, individual banks themselves, that concern has actually gone away. And frankly, as far as global investors are concerned, they're very used to seeing some large business groups once in a while having all kinds of troubles. They've seen this in China, in Brazil, in Mexico, Indonesia, etc. So they're not too hassled by these kind of developments. They know that in emerging markets, the risk element is always a bit higher. So you have to position your portfolio accordingly, figure out your position sizes in each stock you invest in depending on your risk appetite. So you get all types of investors, some funds who might be even looking to buy some of these stocks, some who will still not touch them despite the sharp stock price decline, some who couldn't be bothered, who are looking more at, let's say, the banks or the consumer stocks or the IT services companies or cap goods companies. So as long as they're clear that this controversy doesn't impact any of that, then they don't even care about what's happening over there.
Pratik, final question before we let you go. What about the broader markets? Everyone's talking about maybe the Nifty is not moved from XYZ till date. We were at 17,000, 17,500. But you'll ask a lot of people out there, they'll say, my portfolio is feeling like 15,500 or 16,000. Is there appetite for, some of these mid-cap, these small-cap names as well? Because the big compounders will do well in the next 5 years or so. But the real money will be made in the mid and small caps. What's your sense?
So firstly, in mid caps, the way, at least I always recommend people to look at, you might get some really high quality companies which are mid caps, but which may be leaders in their respective industries. So it could be a hotel company or a chemicals company or maybe a footwear company or a QSR company. They may be mid-cap from a market cap perspective, but in their respective industries, they may be dominant players. So I would say, and I would agree with you that in some of these so-called mid-caps, as you call them, there is huge potential over the next 4 or 5 years. There, the concerns are more in the short term, especially more so amongst the local investors who tend to be bigger investors. They have a bigger share of the public float in mid caps than the foreign investors, for whom liquidity is a bigger criteria. Their position sizes overseas, they want them. They typically invest more in large caps, less in mid caps. And for local investors, one of the concerns, apart from the ongoing sort of slowdown we are witnessing right now, is more not about the structural long-term prospects, but more about concerns about the near term, given A, is the demand slowdown we're seeing in pockets of the economy, and obviously ongoing execution risk. But also from a liquidity standpoint, you've seen market volumes come off quite sharply last few months. And the worry is if some global fund somewhere or even a local fund, they start selling or they face redemptions, the liquidity in these stocks has come off very, very sharply, so that can have a disproportionate impact on the price. But equally, some of them see it as an opportunity that if that happens, if the stocks come off due to non-fundamental liquidity-driven reasons, that's an opportunity to buy. But in general, the longer-term folks are not really concerned. They are actually hoping for a correction in these mid-caps and some really high-quality businesses that if a correction comes, that actually come in to buy quite aggressively.
Okay, all right, Pratik. Thanks so much for stopping by, giving us your view, and wishing you and your team a good conference. Appreciate you joining in. Well, by the way, at the start of the show, Surbhi, we promised you that it's going to be a volatile final 30 minutes or so.
Yeah.
And that's the way it's playing out, right? Mangalam,
it's all happening now,
fireworks
guys.
was promised from the markets, not from us. But just pull up the intraday charts on the Nifty. We're down close to around 60 points in the last 7 to around 8 minutes. So from the time we started that chart with Pratik, intraday chart comes up for you on the screen. The Nifty has moved lower, a sharp downtick. That 3 p.m. move has come about, and the bulls will be hoping that we don't see a deeper gash, because as is from the high of the day, we're 130 points off. Surbhi.
Yeah, we've broken 17,500 in the bargain. Let's see how this goes and whether it stops over here. Just want to pull up some of the key losers. Look at Asian Paints. There's a sizable down move actually on Asian Paints, 3.2% now down. Then you have the likes of Titan, Infosys, Britannia, HDFC Bank. It's a long list. We'll just flash some of the Nifty losers for you as we move into the next story, which is actually a very important one as well. And it's time to get some updates on the Adani saga, specifically LIC's holding with respect to some of these stocks. And the fall in the Adani Group stocks is now beginning to hurt. That's what it appears like. Yash Jain is joining in with the latest. Yash, what are you picking up?
Oh, well, that's correct. So the big headline today is that LIC's investments in Adani Group companies has turned negative. Now, we've put together some interesting numbers supporting the headline, and these numbers also throw some interesting facts. Interestingly, LIC is likely to have sold Adani Group shares worth 6,400 crore rupees in January 2023. How did we reach that conclusion? Now look at the turn of events on January 27th. LIC disclosed that the value of its investments in Adani Group companies was at 56,142 crore rupees, when the same for the same day is calculated taking the December shareholding under consideration. Then in that case, the number as far as the holding is concerned, that comes to 62,550 crore rupees. The difference is about 6,400 crore rupees, or 10% of LIC's holding in Adani Group companies, which is likely to have been sold between January 1st to January 24th. Now let's come to the point of LIC's investments in Adani Group companies turning negative. Now as of yesterday, value of LIC's investments in Adani Group companies, that stood at 33,632 crore rupees. Adjust this to that possible 10% stake sale which came in January. That will give you the number of 30,221 crore rupees. Now compare this to LIC's total cost of purchase, which is 30,127 crore rupees, and it will tell you that till yesterday LIC was sitting on a mark-to-market gain of just about 94 crore rupees on its Adani investments. Today, LIC's value of investments in Adani companies has eroded by over 500 crore rupees, which practically not just takes away that 94 crore gain left yesterday, but pushes the largest life insurance company into losses on its investments in Adani Group companies.
Okay, all right. Yash, thanks a lot for that interesting piece.